In our Spotlight on Business report tonight, the U.S. is turning an important corner in the years-long fight against inflation. The Federal Reserve today slashed interest rates by a half a percentage point, which is a more aggressive move than some economists expected. The decision came in a split vote at the end of a two-day policy meeting. The action marks the Fed's first interest rate cut in 4 years and charts the course for 2 additional cuts this year, followed by 4 more in 2025. Rates, of course, had previously been held at a 23-year high since last July. So what does it mean for you and the job market? I'm joined by Farokh Langdana, the director of the Rutgers Executive MBA program. Professor Langdana, thanks for coming on the show. Why did the Fed decide to move so decisively now, in this moment?
You know, this is actually a huge moment because it's been a while since we've had such a drastic rate cut. We've had 11 rate hikes, as you know. So the Fed's been stepping on the brakes since inflation came back in 2022. You know, inflation had vanished from our country since 1981. Then it came back in 2022, and the Fed hit the brakes 11 times. Then what's happened now is that while the inflation is down, it looks like they have engineered a soft landing. The labor market was throwing up these red lights. And this time the Fed's trying to get ahead of it. If you remember, when the Fed was cutting rates or trying to hit the brakes earlier on, it was behind. There was criticism that they're waiting too long, or they shouldn't have done enough, or they should have moved earlier. And I was telling people, you know, you're in the middle of COVID. You don't raise rates in the middle of COVID, you know? So the Fed was under some flack earlier on for being late. So I think now,
Is it
I was
playing catch up
surprised too.
now? Would you say they're playing catch up?
You know, I think now it's a point at which the market's already baked in a rate cut. And the thing is with macro, and I'm an engineer by training, my undergraduate degrees in engineering, macro is strange because it's got these weird lags, these annoyingly long lags, you know. So when you turn on the light or turn off the light in macro, the light can go off now or might go off in a week or in 6 months or not at all. So you have these huge lags. And so the Fed is determined that, okay, let's not go into a hard landing. A hard landing is when you bring down the economy, you know, you bring down overheated growth, you bring down inflation, but then you tap the brakes to make sure it just doesn't go all the way into a hard landing, which is unemployment. And so they are making sure that they are proactive this time and that the job market recovers.
Well,
You see what's happening.
the light switch analogy, Professor, makes a lot of sense. The question, I think, on most consumers' minds is this going to ease financial pressure on them? What's it going to mean for the consumer now?
So, you know, anyone with a credit card payment, adjustable rates, adjustable rate mortgages, they will see an immediate benefit right away. And keep in mind, consumption, household consumption, that's 70%, 70 of our economy. Okay, that's the turkey on the Thanksgiving table, given that that's around the corner. So that's the big one. You know, forget government spending, forget exports, forget business spending. Consumption, what you and I spend, is 70%. It's the turkey on the Thanksgiving table. And consumption is going to pick up in the short run. There is no doubt. Because look, consumption has 3 components. One is after-tax income. One is consumer confidence. And the third one is wealth. That's housing. So housing prices, if you own a house, you're feeling wealthy. So that's a plus. After-tax disposable income has actually inched up finally post-COVID, just recently. And the consumer confidence, the first one, that's the big one. That's getting a big boost with this 50 basis points cut.
Let me ask you, is there a downside? Yeah, is there a downside, Professor? And I'm thinking about those high interest savings accounts and money market accounts that people took advantage of in these last couple of years.
Exactly. So, you know, as interest rates fall, it's going to benefit borrowers and hurt savers. And for the last couple of years, I was telling people for once, savers are going to get something out of this. That story is going to fade now as interest rates fall and CD rates come down. But keep in mind, Brianna, the 30-year mortgages, the long-term borrowing those rates have nothing to do with what the Fed did today. Okay, the Fed, and people don't really understand this, the Fed can only affect short-term overnight rates called federal funds rates. The Fed has pretty much no control over 30-year mortgages.
Professor, I have to stop you there, and we'll have to continue this conversation.
Absolutely.
A lot more to discuss. Professor Farrukh Langdana with the Rutgers Business School. Thanks so much.
Thank you. Thank you very much.
Support for the Business Report is provided by Experience the Vibrancy of Newark's Arts and Education District and Halsey Street. Halsey, a neighborhood built on heart and hustle. Visit halsey-w-k.com for the 2024 Halsey Fest schedule.